Thank you, ladies and gentlemen, for keeping tuned at Smart 24 as we drive your business. Now, this is the channel that will bring you information regarding business 24/7, and we will commit ourselves to bring you all the information you need to know what businesses you need to carry out, how business is running in East Africa and in Uganda. You just have to tune into our channel on GoTV channel 394, as well as stream live if you can't on our YouTube channel, that is a Smart 24, and follow us on Twitter at Smart 24 so you can keep in the know in terms of what is driving business in East Africa, in Uganda in particular, and the world at large. Now we go into our top stories this morning. Ghana and Uganda ban grain and food exports. Now, Ghana and Uganda are among several countries in Africa that have banned the export of grains and other farm produce, with the latter, that is Uganda, imposing very high taxes to prevent food exports to neighboring countries. Now, the Ghanaian government has extended a ban on grain exports, a temporary ban on the exporting of maize, rice, soybeans, and other grain, which took effect in September last year, will now run until September 2022. The original ban was put in place to ensure food security and increase the local poultry and livestock production. The extension of the ban comes as grain prices soar, partly because of Russia's war on Ukraine. Now, but some farmers are unhappy with the extended ban, saying they would get better prices if they could sell crops outside of Ghana. So they want the government to lift it. Now, as you know, the war in Ukraine has impacted so many people, and so many livelihoods have been affected, with food insecurity as one of the leading problems today in the world, with UN as well coming out to warn the world, especially the countries in the developing world, like Uganda in the East Africa, like Ghana in West Africa, that actually there could be food insecurity, and is already being witnessed in Uganda, for example, in Karamoja, as well as in other parts of Africa, like Ethiopia, Kenya, that is northeastern Kenya, and so on. Now, it's struggling farmers. It's early morning in Yilo, Nayili village, and Mr. Tamari, who is the Ghana, is a northern Ghanaian farmer, a 46-year-old, a small-scale local farmer. They were busy thatching and their roof, and at this time of the day he would usually be tending to his crops, but the soaring price of fertilizers in Ghana means that they cannot tend to their gardens as often as they would wish. He says that we have to plow our farms, but the prices of fertilizer and chemicals break our hearts because we cannot afford to buy them this year. Now, a recent government directive banning the export of grains translates into abject poverty for Mr. Wangarindo, who is a Ghanaian farmer. He had hoped that the grain shortages on the international market would be a boost to his income, since he would sell his produce of corn and soybeans at higher prices. For Mr. Wangarindo, the decision to ban the export of their products is a big blow to him and other farmers in Ghana. If the government cannot control, he says, the prices of farm inputs like fertilizers, how does it expect to stay in business by lowering the cost of our produce? Now, Ghana justified the ban on grain, as according to Mr. Christopher Aki, who heads the unit that issues certification for grain exporters. Due to the current situation, that is the war in Ukraine, the government decided to take measures to stop the exportation of grain in order to make a food balance stable in the country. That is according to Mr. Key. That is why there is a ban on the major food crops that we all know, that is maize, rice, and soybean. Now, around Africa, farmers are grappling with high costs of farm inputs this year, with many governments attributing the costs of these inputs to the Russia-Ukrainian war. However, the head of applied economics at Ghana's University for Development Studies, that is in Tamale, that is Dr. Michael Ayamga, feels the government needs to think things through before imposing such bans, especially on sensitive agricultural products like maize and rice. You need to use the market mechanisms, he says, and not the draconian and controlled approach government has adopted by trying to make it impossible for farmers to export rather than giving them incentives to sell within. That is according to Dr. Ayamga. Many farmers in Ghana fear the ban could create a black market if the government fails to negotiate appropriately with farmers. Now, back here in Uganda, alternative routes have been set. A grain transporter to Daybell in South Sudan, Mr. Moses Mahmoud, told us that his truck had to go through the Democratic Republic of Congo and Central African Republic to beat the roadblocks set up by by custom officials. The government in Uganda is overtaxing to stop us from taking food outside Uganda. This has affected our businesses and that are the main source of livelihoods, as he said. Another transporter of grain and other food products, Andrew Kasim, said before the war in Ukraine, things were okay. We could send 3 lorries to South Sudan packed with various products, but as you can see now, there is nothing to transport. Now, authorities in Uganda have imposed high taxes on food products such as maize, soybeans, rice, and wheat to try and prevent the traders from selling their products outside Uganda. Uganda's Minister for ICT and National Guidance, Mr. Chris Baryomunsi, defended the government's position, saying that Uganda is now focused on boosting production to ensure that we have enough supplies and don't run into scarcity. Therefore, the comfort that we give Ugandans is that they should be patient and persevere. It's a global phenomenon, but soon the prices shall stabilize and we return to normal export of food products. That's according to Mr. Baryomunsi. Now, in a recent address to the nation, Ugandan President Mr. Yoweri Kaguta Museveni said his government would not intervene amid an outcry from food exporters and the rising cost of living. Mr. Museveni said that government subsidies or removing taxes would collapse the economy, and surges have occasioned the rising prices of goods in the cost of petroleum products and other imports amid global supply chain constraints following the war in Ukraine. Now, subsidies for and removing taxes from imported products is suicide, according to Mr. Museveni, because it will deplete both the family savings and the national reserves, added Mr. Museveni. But economist Julius Mukunda disagreed with Mr. Museveni, attributing the high costs for commodities to the Russian-Ukrainian war and not intervening. Instead, he said the government should instead give incentives to business owners to boost their trade. And the Russian-Ukrainian war effect hasn't arrived yet. It is likely to begin probably next year. We are experiencing the effect of COVID-19 pandemic, however. Therefore, our government must support small businesses. That is according to Mr. Mukunda. That is a story coming in, and we shall be giving you more concerning that story about the very high taxes that are being imposed onto products that have been earmarked, especially food crops like maize, rice, and wheat, as well as soybean right there. So Ugandans should be careful, especially people who are dealing in these products. Remember, some of the monies we use from financial markets, the money we have got from our investment in financial markets, we may need to apply in agriculture. So, but before you put this money back in agriculture, you have to look at the trends of what's happening in the agricultural sector in terms of imports and exports, taxation, and the like. So if at all you have been doing a business in terms of food crops like maize, grain, that is also rice and soybean, as well as wheat, you have to be careful, because now the taxes are high as government is trying to control exportation of such key products in order to for us to have a secure food ecosystem, so that we don't run out of food like other countries already are grappling with food insecurity around us. So we will be following up more on that as we check out what is happening on the food market right there in Uganda. Now, last week in another story, NSSF recently had said that it was running out of investment options in Uganda, and it is surely involved in many sectors. Now, NSSF's investment range from various equity markets back to properties and so on, in a wide range of investment portfolio that NSSF has, and it has invested in companies like Equity Group, that is Equity Bank, as well as Kenya Commercial Bank and Centum through the Nairobi Stock Exchange, and which is a significant exchange for the scheme, because they all have a presence in Uganda through their subsidiary companies. Now, last week, the National Social Security Fund completed a 59.4 billion share acquisition from British private equity firm Actis to become the major majority shareholder in Umeme, that is Umeme Uganda Limited. The new shares lifted NSSF from its 14.3% to 23%, cementing its position as the top investor in power distributor Umeme. Now, that also meant that NSSF's presence in the energy sector is increasing, and Umeme is the only energy-related company in Uganda where NSSF's money has been invested. Now, NSSF, as you all know, that is National Social Security Fund, is a savings scheme, a national savings scheme that is mandated by government through the National Social Security Fund Act, CAP 222 laws of Uganda, to provide social security services to Ugandans, especially the employees, in the formal as well as the informal sector. It was established by the Act of Parliament in 1985 to provide its membership payment of contributions to payment of benefits of the fund. This is a provident fund paying out contributions in a lump sum. For the last financial year, for example, in the financial year 2015-2016 alone, the fund declared a paid an interest of 12.3%, and that has been the range, 12.3, 12.5, and as well 13%. They're peering towards 13%. Interest on all the savings that the savers were actually making with the scheme. Currently, NSSF is sitting on more than 6 trillion worth of assets. NSSF has more than 600,000 active members, dominating the pension sector in terms of investments and returns. The other schemes that are enrolled are by UBRA, that are regulated, by UBRA, that is the Uganda Retirement Benefits Regulatory Authority, include the Kasita and Mazima pension schemes that were launched a couple of years back, that is around 2016. 3 months ago, before these companies, when these several companies paraded themselves as distressed because of the weak economy and large exposure to bank debt, the Uganda Manufacturers Association suggested that NSSF be freed to invest in other companies. And on a monthly basis, the fund collects about 70 billion Uganda shillings money that has been invested, but that has to be invested. So they collect about 70 billion, which is increasing steadily, and I think this year they will declare, but at least 70 billion has been collected from Ugandans by the scheme and well invested. At the annual members meeting, Mr. Richard Idbak in October last year, Mr. Richard Byarugaba, the NSSF managing director, told members that they were running out of investment options in Uganda. Now the question is, where is the NSSF's money in Uganda's economy? Now, NSSF is a lender to government, and the largest portfolio of NSSF's money is lent to government through the purchase of treasury bonds. Treasury bonds, as you know, are loans to government. These are bonds that are usually issued as domestic debt and a function of purchasing, and the function of purchasing is carried out by the Bank of Uganda. As at the end of, for example, June last year, the NSSF was holding on to about 3.7 trillion in Uganda government debt. Whenever the government issues a call for applications for debt, NSSF is often the first in the queue and setting the pace in terms of price, and indeed it is given the green light. Often NSSF will compete with commercial banks on who takes the largest share of the government debt. Obviously, the consequences of the government debt acquisition are to crowd out the private sector from accessing credit. Mr. Byarugaba often notes that NSSF is already financing government spending, and the only problem is that the domestic debt is too general and not pegged to specific projects. For example, in Kenya, NSSF has invested over 300 billion Uganda shillings in infrastructure bonds, which are pegged to infrastructure development of the nation. But here in Uganda, mostly the debt is not actually pegged to a specific, investment in terms of, that is the country's economy. The NSSF is the largest investor on the Uganda Securities Exchange, and of the about 10 listed companies, locally listed companies, NSSF has shares in Wumeme, Stanbic Bank, DFCU, Bank of Baroda, Uganda Clays, and Vision Group. The total value of shares they hold is about 400 billion, and it's increasing steadily. There is no single investor in the country that holds that sort of investment in the Uganda's capital markets. Mr. Paul Bwiso, who is the Uganda Security Exchange Chief Executive Officer, reported that recently NSSF's participation on the stock exchange provides confidence for institutional investors looking to place their money on the Ugandan listed companies. NSSF participates in the banking sector by investing in 3 very big banks. It is also publishing and construction. It is also in publishing and construction sectors through the Vision Group and Uganda Clays, respectively. NSSF's investment in the equity group, KCB and Centum through the Nairobi Stock Exchange is significant because they all have a presence in Uganda with their subsidiary companies. In the past as well, this has been one of NSSF's big investments, and it has been one of the companies that has invested most. And Wumeme recently, as I told you earlier, declared a dividend of 73.2 billion Uganda shillings to the NSSF fund. That is a story right there. We'll be keeping ourselves in touch with. We are going to talk to Mr. Mwima, but I think he may be delayed a little bit. We may come around midday with Mr. Mwima Andrew, who is a trading manager from the Uganda Securities Exchange. We are going to go into a short break, but we return with more content on financial markets. Don't go anywhere.